That $700 car payment you're making every month isn't just costing you $700. Over time, it could quietly steal hundreds of thousands from your future wealth. You earn $100,000 a year. 10 or 20 years ago, that sounded like success. A six-figure salary meant comfort, stability, maybe even a little freedom. But today, many people earning that exact amount feel something very different. They feel broke. Not poor, not struggling in the traditional. You earn $100,000 a year. 10 or 20 years ago, that sounded like success. A six-figure salary meant comfort, stability, maybe even a little freedom. But today, many people earning that exact amount feel something very different. They feel broke. Not poor, not struggling in the traditional sense, but constantly waiting for the next paycheck. So the real question is uncomfortable but important. How can someone earning $100K still feel like they're living paycheck to paycheck? Scene 2. A relatable scenario. Let's imagine a very normal situation. A 29-year-old professional living in a mid-size American or European city, maybe Austin, Denver, Manchester, or Berlin. They did everything right. They studied, graduated, found a stable job. Their salary, $100,000 per year. At first glance, that sounds like a lot. But after taxes, things already look different. In the United States, depending on the state and deductions, that $100K salary often becomes about $70,000 take-home per year. That's roughly $5,800 per month. Now let's look at a normal lifestyle. Rent for a decent apartment in many cities, $2,000 per month. Already, more than a third of the income is gone. Add utilities and internet. Now it's closer to $2,200. Scene 3. Everyday costs. Next comes transportation. Maybe a modest car. Not luxury, just practical. Car payment, $450 per month. Insurance, $150. Fuel and maintenance, $200. Transportation alone is now about $800 per month. Now we're at $3,000 of the monthly income already committed. Next comes food. Groceries, occasional takeout, coffee with friends. That easily reaches $600 to $700 per month. Let's say $650. Now the running total is $3,650. Then come the invisible payments many people carry quietly. Student loans, maybe $400. Now we're at $4,050. Health insurance or medical costs, let's estimate $300. That brings the total to $4,350. Add a phone plan, streaming subscriptions, gym membership, another $200. Now the monthly total reaches $4,550. Remember the take-home pay? $5,800 per month, which means after basic modern life expenses, only about $1,250 remains. And that's before travel, emergencies, gifts, repairs, or saving for retirement. Scene 4. The hidden financial mistake. Here's where something subtle happens. Most people don't feel wealthy when they earn more. They simply upgrade their normal. A slightly nicer apartment, a newer car, better restaurants, more subscriptions. Nothing extreme, just small improvements. But those small improvements quietly absorb every salary increase. This phenomenon is often called lifestyle inflation. But the deeper issue isn't spending, it's how people mentally define affordability. Most people ask a simple question before buying something. can I afford the monthly payment? Not, can I afford the long-term cost? Scene 5. Simple math that changes everything. Let's take that car again. A $450 monthly payment may seem manageable, but most auto loans last about 5 years. $450 times 60 months. That's $27,000 for a vehicle that will likely be worth far less when the loan ends. Now imagine a few similar decisions over a decade. One car loan, another upgrade later, maybe furniture financed on credit, a few thousand carried on credit cards. Individually, these payments look small, but together they form something powerful: permanent monthly obligations. And permanent obligations are what make even large salaries feel small. Scene 6. The psychology behind it. There's also a psychological factor at work. Humans adapt extremely quickly to improved living conditions. A new apartment feels exciting for about 3 months. After that, it simply becomes home. A higher salary feels impressive until friends earn the same or more. What once felt like success slowly becomes the new baseline. Psychologists call this hedonic adaptation, and financially it creates a quiet trap. Every improvement raises expectations, but expectations grow faster than income. Scene 8. The long-term impact. The real problem isn't the monthly stress, it's the long-term opportunity cost. Let's return to that $1,250 left each month. If half of that disappears into random spending, only $600 per month might actually be saved. Over a year, that's $7,200. Over 10 years, even before investing, that's $72,000. But if that same money had been invested consistently, the number could easily grow far beyond that. Instead, many six-figure earners reach their late 30s or early 40s with something surprising: high income, but very little financial flexibility. Not because they earned too little, but because their financial structure expanded exactly with their income. Scene 9. How financially intelligent people think. Interestingly, people who eventually build real financial stability often think differently. Not necessarily more disciplined, just more aware. They rarely measure affordability in monthly payments. They measure it in years of freedom lost or gained. They also treat raises differently. Instead of upgrading their entire lifestyle, they upgrade it selectively. One improvement, not 10. They understand something subtle about money. A salary creates income, but financial margin creates peace of mind. And margin only exists when income grows faster than lifestyle. Conclusion. Calm perspective. So when someone earning $100,000 says they feel like they're living paycheck to paycheck, they're not exaggerating. In many modern cities, the structure of everyday life makes it surprisingly easy for even strong incomes to feel tight. Not because people are irresponsible, but because the system quietly encourages spending through convenience, credit, and social expectations. Understanding this isn't about guilt or cutting every small pleasure. It's simply about seeing the numbers clearly. Because once the math becomes visible, people tend to make calmer, smarter financial decisions. There's another layer to this problem that most people don't talk about. Social pressure rarely appears as pressure. It appears as normal life. Think about what a typical middle-class life now includes: a comfortable apartment, a reliable car, a smartphone upgrade every few years, vacations once or twice a year, streaming platforms, occasional dining out. Individually, none of these look extreme. But together, they create a financial standard that quietly consumes most modern salaries. 20 or 30 years ago, the middle class owned fewer subscriptions, financed fewer purchases, and upgraded technology much more slowly. Today, convenience is everywhere, and convenience almost always comes with a monthly payment attached to it. The subscription economy. Modern life has shifted from ownership to subscription. Music, movies, software, fitness, cloud storage, delivery services. Each one might cost only $10, $20, or $30 a month, which feels insignificant. But the human brain struggles to track dozens of small financial commitments at the same time. Let's imagine just a few. Streaming platforms, $40. Music service, $10. Cloud storage, $10. Gym membership, $60. Food delivery subscription, $10. That's already $130 per month. Over a year, that becomes $1,560. And most people have far more than 5 subscriptions. The system is designed this way intentionally. Small payments feel painless, but collectively they slowly tighten financial flexibility. Housing, the single biggest expense most people face. Then there's the single biggest expense most people face: housing. In many cities across the United States and Europe, rent has increased far faster than salaries. A decade ago, a $100K salary placed someone comfortably above average. But housing prices didn't stay still. If rent climbs from $1,400 to $2,000 over several years, that's an additional $7,200 per year just to live in the same type of place. And most people accept that increase as unavoidable, because housing is not just a financial decision. It's a lifestyle and identity decision. Where you live affects your commute, your social life, and even how people perceive your success. So people stretch their budgets to maintain that image, not out of vanity, but because belonging matters. The credit card illusion. Credit cards add another quiet layer to this system. They don't usually create massive debt overnight. Instead, they smooth over small financial gaps. A dinner here, a flight there, a repair that wasn't expected. If the balance slowly grows to $5,000 and the minimum payment is around $150, it feels manageable. But with typical interest rates, that $5,000 balance could cost thousands more if it lingers for years. Credit doesn't always create financial crises. More often, it creates financial fog, where the real cost of decisions becomes harder to see. The income trap. Ironically, higher income can sometimes make this worse, because lenders trust higher earners more. A person making $40,000 may struggle to get approved for large loans. A person making $100,000 will have credit offers everywhere. Dealerships offer better financing. Banks offer higher credit limits. Mortgage brokers offer larger home budgets. The system assumes higher earners can handle more financial commitments. And mathematically, that's true. But psychologically, it also encourages people to operate very close to their financial limit. The quiet difference of financially stable people. People who eventually become financially stable often do something subtle but powerful. They protect their financial breathing room, not by eliminating spending entirely, but by maintaining distance between income and obligations. For example, when their income increases by $1,000 per month, they might only increase their lifestyle by $200 or $300. The rest quietly strengthens their financial position. Emergency funds grow. Investments slowly accumulate. Debt disappears faster. To outsiders, their life may not look dramatically different, but internally the pressure feels completely different, because their money isn't already promised to future payments. A different way to look at income. Most people think about money in terms of salary, but financially stable people often think about it in terms of control. Two individuals may both earn $100,000, but if one has $4,500 in monthly obligations and the other has $2,800, their financial lives feel completely different. The second person has something extremely valuable: time flexibility. They can change jobs, take career risks, handle emergencies, or simply sleep better at night. Not because they earn more, but because less of their future income is already spoken for. Final perspective. So the feeling of living paycheck to paycheck at 100K isn't necessarily about bad decisions. It's often the result of a modern economic structure built around monthly commitments: housing payments, car loans, subscriptions, credit, lifestyle expectations. Individually reasonable, but collectively heavy. The goal isn't to reject modern life. It's simply to recognize how the system works. Because once you understand where the pressure comes from, you start seeing financial choices differently. And that awareness alone can quietly change the direction of the next 10 or 20 years.